Marcus Bell had $840,000 saved, enough to walk away from his job at 56. Enough, he thought, until his wife looked at him one night and asked a question that stopped him cold. What happens if one of us gets sick before Medicare kicks in? Marcus didn't have an answer. He'd spent 15 years building a spreadsheet for retirement, contributions, compound growth, withdrawal rates. He knew his numbers cold. But healthcare wasn't on that spreadsheet. And it turns out, for a lot of people planning to retire early, that's the piece that quietly wrecks the whole plan. Marcus was a plant supervisor outside Columbus, Ohio. Good job, steady paycheck. The kind of job where your health insurance is just there. You don't think about it. It's automatic. Until it isn't. He had 9 years standing between him and Medicare eligibility at 65. 9 years of doctor visits, prescriptions, the unexpected stuff nobody plans for. And the first quote he got back made his stomach drop. $1,400 a month. That was just to keep his old employer coverage going through COBRA for him and his wife. $1,400 every single month for coverage that used to cost him $60 out of his paycheck. He did the math. Over 9 years, if COBRA even lasted that long, which it doesn't, that's well over $150,000. And COBRA only runs about 18 months before it disappears entirely. So COBRA wasn't a plan. It was a temporary parachute. He needed something that could actually last the distance. That's when Marcus discovered something most working Americans never think about, until they're staring down this exact wall. The healthcare marketplace, the one built under the Affordable Care Act, works completely differently depending on one number. Your income, specifically, something called your Modified Adjusted Gross Income, or MAGI. Stay under a certain threshold, and the government will subsidize a huge chunk of your premium. Go over it, and you're paying full price. Full price that can run $1,500, $1,800 a month for 2 people. Marcus ran the numbers both ways. If he kept his retirement withdrawals low enough to stay under that income line, his premium dropped to around $280 a month. If he didn't manage it carefully, that same plan jumped to over $1,600. Same coverage, same doctors. A $1,200 swing every month based on one number on a tax form. Here's where it got complicated for Marcus, and where a lot of early retirees get stuck too. Staying under that income threshold meant living differently than he wanted to. Fewer big withdrawals, more careful planning around Roth conversions, delaying a kitchen renovation his wife had wanted for 3 years. He felt it. That tension between the number on the page and the life they'd actually pictured living. There was another option sitting quietly in the background. One, a coworker mentioned, almost in passing, a health-sharing ministry, not insurance, technically. A community of members who pool money to cover each other's medical bills. The cost looked incredible on paper, around $350 a month for both of them. But when Marcus dug into the fine print, he found the catch. No guarantee of payment. No state insurance regulation protecting them if the ministry decided a claim didn't qualify. And for pre-existing conditions, some ministries simply won't cover you at all. Marcus had high cholesterol. Nothing dramatic. Just a number his doctor kept an eye on. That one line on a lab report was enough to make him nervous about betting his family's financial future on a program with no legal obligation to pay. He passed, reluctantly. What Marcus finally landed on wasn't glamorous. It was a layered approach, built with an independent insurance broker who specialized in exactly this gap. A high-deductible marketplace plan, kept affordable by carefully managing his income and staying under that subsidy threshold. On top of that, a supplemental policy covering major diagnoses like cancer or heart attack in case the unexpected happened and the deductible hit hard in a single year. All in, Marcus and his wife landed around $520 a month. Not free, not perfect, but survivable. Something their retirement budget could actually absorb without derailing everything else. The lesson Marcus took from all of this wasn't really about insurance at all. It was that early retirement isn't about eliminating risk. It's about choosing which risks you're willing to carry and building a plan that can absorb the ones you can't avoid. He didn't get the flawless, worry-free coverage he'd hoped for walking in. Nobody really does. What he got was a plan he could live with, one that let him actually walk away from that plant job at 56, instead of grinding out 9 more years just to keep a health insurance card he barely used. If you're eyeing an early retirement date, here's the honest truth. The number that stops most people isn't their 401k balance. It's the gap between the day they quit and the day Medicare starts. Look at your income and how it affects marketplace subsidies. Get real quotes, not estimates. And talk to a licensed broker who works in this space every day, because the rules around subsidies and pre-existing conditions shift more often than people realize. Marcus figured it out. It took months of quotes, spreadsheets, and a few uncomfortable conversations with his wife about trade-offs. But he figured it out. And that's really what financial freedom looks like. Not a perfect plan, just one you understand well enough to trust. If you want more real, honest breakdowns like this one, on money, retirement, and building a life you actually want, stick around and subscribe to Money IQ Pro. We break down the stuff nobody explains, simply, so you can make decisions with your eyes open.